welcome back to our channel. I'm Shannon Carter. I'm a real estate agent and investor.
I'm Jackie Hurtis, and I'm a residential mortgage lender.
And I'm Sasha Qualkenbush, a real estate attorney.
And we're
the Property Queens.
Today we're going to be talking about factors that drive your interest rate.
So just a quick market update on rates to tell you guys where we're at. Rates are at they're not all-time low. They're at the lowest they've been in over a year. So it's a really good time if you spring market, you guys are thinking about purchasing or refinancing, it's a great time to do it. But I wanted to go over, the question I get asked all the time is, what's your rate today? And there is no one rate. That's not how it works. Every lender has like their par rate, but then there are multiple different factors that are going to influence your specific rate. So today we're gonna kind of highlight the big ones for you. Number one, biggest factor is credit score. There are different tiers. So conventional program, there are 7 different tiers to credit score tiers. 740 and above is considered top tier. So if you are 740 or above, you're gonna get the best interest rate. Then it's 720 to 739, and every 20 points down and down. So the higher your credit score, the better rate you're gonna get. It's just all interest rates are risk-based. So the less risky the loan, the better interest rate you're gonna get. So therefore, higher credit score, better interest rate.
Number 2 is going to be your loan to value. So obviously if you're doing 100% finance loan, it's going to be a higher interest rate because obviously you're more of a risk. The more you put down, you're going to get a better interest rate. So that is also a factor that drives your interest rate.
Number 3 is the type of loan. So there are government loans. You can get a FHA, a
VA,
USDA. There's also THDA, conventional loans, and all the different types of loans each have their own interest rate and what factors into it.
Yeah, so government is going to typically be a little bit better rate than if you were going to purchase conventional, so just know that ahead of time. And then THDA has its own rate. I know they're dropping down to 4.5%, so everyone who does THDA is going to get that 4.5% rate regardless of credit score and all that. So just be aware that each loan program is going to have a little bit different interest rate. So when you're talking to a friend at the office and they say, oh, I just got 4.5%, and you're at 4.75, don't initially assume that your lender is somehow screwing you over. You guys just might be doing different things. Your situations are not the same. So something to keep in mind. Another big factor, escrow accounts. So most of the time you're gonna escrow for your homeowner's insurance and property taxes. So you are paying each month into that escrow account so that when those bills come due at the end of the year, your mortgage servicer can pay those for you. If you put 20% down on a conventional loan, you can waive escrow accounts, which means we don't require you to pay into that each month. That is a little bit riskier. If you're escrowing, we know that you're paying those bills. If you choose to waive that right, we can't force you to pay those. So like I said, a riskier loan, a little bit higher interest rate. You're gonna take a little bit of a hit if you do choose to waive the escrow account.
The term of your loan will also drive your interest rate. So if you are on a 15-year fix or a 30-year fix or an ARM, all those will factor, what the riskier loans are going to be, a higher interest rate. So obviously if you can pay down sooner, then it's gonna be generally a lower interest rate.
Yeah, so if you're doing a 30-year fixed rate mortgage, you're obviously going to have a little bit higher interest rate than if you did a 15-year because they're guaranteeing that interest rate for a longer period of time.
All right, the next is lock period. So this is when your interest rate gets locked in for a certain amount. So the shorter it is, it's better.
Yes. So the longer, if you go and look at Wells Fargo today, they're going to quote you an interest rate, and I believe theirs is a 30-day lock. So standard lock-in period is usually like 30 to 45 days because that's typically the amount of time it takes to get a house from contract to close. But for whatever reason, you might not be closing for 60 days or you're doing new construction and you might be 6 months out. The longer your lock period, the worse your rate's going to be because that lender has to guarantee that rate for you for that amount of time. And there's volatility in the market, so they're locking you in at 4.5%, but we don't know where rates are going to be at in 6 months. So you're going to take a hit for that rate. So the shorter your lock period, the better rate you're going to get.
So especially for new construction, Just be cognizant of that, because if your closing date is set for, let's say, 60 days out, and then you end up, or 100 days out, and you have a 160-day lock period, then if you keep extending it out and you can't get the certificate of occupancy, we call it the CO. If you can't get the CO in time and you keep pushing back the closing, you need to make sure that you're not going outside of your lock period. That's happened to us before on one of our new constructions, and it was just a mess to try to close in time, and we had to work with the lender to make sure that they could extend that period for them. It was just rough.
Yeah, make sure that if you're doing new construction, you want to work with a lender who does a lot of new construction. We work with builders all the time, so we're constantly watching the market. We haven't been doing a lot of long-term locks because the market has been improving so much. But you want to make sure that your lender is educating you on, once you're locked in, like, this is how long your rate is good for, and here's the cost to extend if you do go over. And a lot of times the builders write into their contract that they're not liable if they miss that closing date. So you want to be working with your lender so you know that your lock is good. Yeah. Or you are most likely liable for those extra extension fees. Discount points are a big one. People always talk about, are you paying points for that? And points are essentially buying down the interest rate ahead of time. So it's an additional cost at closing. Your closing costs are a little bit higher, but you get a little bit better interest rate. Just talk to your lender and see if it makes sense for you. If you're planning to be in the home for all 30 years, it can make sense to buy down the rate a little bit. If you know you're going to be out in 3 to 5 years, typically doesn't make sense. You can also go the opposite way. If you know you're only going to be in there for a little bit of time, or you really need help with closing costs, you can take a little bit higher interest rate and get a lender credit back. So just talk with your lender about that. You have options both ways. So if par is someone's quoting you 4% at no cost to you, just know you could probably go either way. A little bit higher rate for credit back, or a little bit lower, but you're paying discount points at closing, so your fees go up a little bit. And like I said, it just depends on your situation, which option is going to be best for you.
The next one is going to be the type of home that you get under contract. So if you are getting a condo that shares walls, or a townhouse that shares walls, generally they're going to have a little bit of riskier loan, so it's going to be a higher interest rate than it would be if you were to buy a single family home. So those are things to think about when you are looking to buy your next home.
A lot of people don't realize this, but with the downturn, a lot of the properties that were foreclosed on were condos. So conventional typically gives you a little hit if you're purchasing a condo. It's usually like 1/8 to 1/4 higher than if you were purchasing a single family home, a townhome, something like that. So just be aware of that. Most people don't know that you do take a hit for purchasing a condo. And you want to make sure, so this comes up a lot too, when you're working with a lender, you want to know ahead of time if it is a condo, townhome, whatnot, because the lender is going to order an appraisal, and it really is important. If it's a condo, we have to get all the condo docs and it's a whole can of worms. So condo and townhome are not the same thing. You want to be aware on the front end which one you're purchasing, because the financing is different.
Side note, I love the way she says condo. Okay, the next one is occupancy. This is going to be whether or not this is your primary residence, secondary residence, if it's an investment property like an Airbnb or a rental. That's all going to affect your interest rate as well.
Okay. And then mortgage insurance, private mortgage insurance is another big one that people don't really think about. Most people know that if you put 20% down, you avoid mortgage insurance. If you go the conventional route, mortgage insurance is there to protect the lender against default. So if you stop making your mortgage payments, the lender can recoup some of that money. If you put 20% down, the lender no longer has that mortgage insurance. So you actually can get a little bit higher rate by putting 20% down versus 15% down. So if you do 15% down, they still have that mortgage insurance in there. So that's just something to be aware of, that sometimes it doesn't actually make sense to put the full 20% down.
All right, thanks for stopping by today and watching our video. Please make sure to like, subscribe, and comment below, and also expand our details if you would like to do business with us. Again, see you next Tuesday.
Bye.
Bye. Condo.